Welcome to the new era of video creation with AI stock picking. Let's start it. Here are the contents. Taiwan's Semiconductor Manufacturing Company, TSMC, is arguably the most important semiconductor company in the world today. It serves as the manufacturing backbone for many of the world's leading tech firms, including Apple, Nvidia, and Qualcomm. TSMC is a pure-play foundry, meaning it manufactures chips for other companies without competing in the design space. TSMC plays a crucial role in some of the fastest-growing industries. It produces chips used in smartphones, AI-powered devices, high-performance computing, and cloud infrastructure, positioning the company as an essential player in global technology. As the world increasingly relies on mobile tech, artificial intelligence, and 5G connectivity, TSMC's cutting-edge semiconductor manufacturing capabilities are more critical than ever. The company has also made substantial investments in advanced chip production technologies, such as 3mm and 5mm chips, which are used in the latest smartphones and AI systems. TSMC's ability to innovate at the leading edge of technology places it in a dominant position for long-term growth. However, as the company has grown, so has its valuation. Let's take a closer look at TSMC's current stock price. TSMC is currently trading at around $110 per share, giving it a market capitalization of about $600 billion. This reflects the company's dominant position in the global semiconductor industry. With tech companies around the world relying on TSMC's manufacturing capabilities, it's no surprise that the stock has grown substantially over the last few years. However, the company is now trading at a PE ratio of around 30x, which is higher than the historical average for semiconductor companies. This suggests that the stock is priced for continued high growth, especially as demand for semiconductors remains strong in the wake of the 5G rollout and the expansion of AI and IoT technologies. The high valuation does reflect the market's belief in TSMC's ability to continue leading the semiconductor foundry business. However, with such a premium price, the stock may be vulnerable to any short-term volatility, especially if there is a slowdown in demand for its products, or if competitors such as Samsung or Intel make significant strides in advanced manufacturing technologies. Let's take a look at where an optimal entry point might be to maximize long-term returns while minimizing the risks associated with the current premium price. For investors looking to enter TSMC at a more favorable price, the $90 to $100 per share range represents an ideal target. This would bring the PE ratio closer to 25-27x, which is still high for a semiconductor company, but more reasonable given TSMC's dominant market position and growth potential. Historically, TSMC's stock has experienced pullbacks during broader market corrections, even though the company's long-term growth trajectory has remained intact. Waiting for a price drop in the range of $90 to $100 would provide investors with a better risk-to-reward ratio and a more attractive entry point into a dominant company in a growing sector. This price range aligns with previous dips in TSMC's stock, often driven by macroeconomic factors or short-term fluctuations in the semiconductor cycle. While these fluctuations don't necessarily reflect long-term growth, they offer savvy investors an opportunity to buy shares at a better price. By entering at a lower price, investors can still benefit from TSMC's strong leadership in semiconductor manufacturing, while managing the risks of overpaying at current levels. Let's now explore why waiting for this ideal entry point is the best strategy. TSMC's stock is currently priced high due to the strong demand for semiconductors, driven by technologies like 5G, AI, and cloud computing. The company is well positioned to continue its growth, but it's important to remember that the stock market is cyclical. When valuations get as high as they are for TSMC, there's a greater risk of a pullback if expectations aren't met, or if there are disruptions in the tech sector. The semiconductor industry is competitive, and while TSMC leads in advanced manufacturing technologies, competitors like Samsung and Intel are aggressively pursuing similar advancements. Any breakthrough from these companies could reduce TSMC's market share or margin growth, potentially leading to a sharp price correction. Moreover, the stock market has been volatile lately, especially in the tech sector. Economic slowdowns, changes in government policy, or geopolitical factors could lead to price fluctuations. Given TSMC's high valuation, waiting for a pullback in the stock would allow investors to enter at a more favorable price, reducing risk while still positioning themselves for long-term growth. In short, while TSMC's growth story remains intact, it's important to wait for the right price, especially given the risks associated with its current premium valuation. TSMC is the dominant player in the semiconductor foundry market, powering some of the most important technologies in the world, from smartphones to AI systems. Its leadership in advanced chip manufacturing makes it a cornerstone of the global tech infrastructure, positioning it for strong growth in the coming years. However, TSMC's current stock price reflects high growth expectations. With a PE ratio of around 30x, the market has priced in the company's continued dominance in 5G, AI, and IoT. For long-term investors, entering the stock at this level may expose you to downside risk, especially if the stock experiences short-term volatility or macroeconomic disruptions. The 90-100 price range offers a better entry point with a lower PE ratio and a more balanced risk-reward profile. Buying at this price would allow you to capture TSMC's future growth in key markets while minimizing the chances of overpaying for the stock. By being patient and waiting for a pullback, investors can position themselves to take advantage of TSMC's long-term growth potential at a more favorable valuation. Timing your entry is crucial to maximizing returns, and waiting for the right price can make all the difference in your investment journey.